Well, those are the big headlines that we'll be tracking for you all day today on ET Now, so stay tuned. Well, first up, let me welcome our very first guest today on the show. It's Sudesh Sadagopan, the founder of Ladder 7 Financial Advisories. Sudesh, many thanks for joining us today on The Money Show. So to start with, Sudesh, we thought of addressing this entire topic on active funds versus passive funds, index funds, ETFs, whichever name they come by. Suresh, would my observation be correct if I say that over the last few years, the kind of alpha, that's extra return that active funds can generate thanks to, of course, there being a fund manager who's actively adding or subtracting stocks in a portfolio of stocks, or rather in the fund, depending on his conviction, has been lower or zero compared to passive funds, especially in these last few years?
Yeah, the answer is going to be far more nuanced, Mubina, in the sense that when we look at what is happening across the board in other jurisdictions, USA and other Western countries, index funds have captured the imagination, ETFs have captured the imagination, and it is very, very difficult for active fund managers to deliver a return higher than the index. So that is the story abroad. Whereas the Indian situation has not still matured to the extent that it has matured in certain other markets. So here, what is happening is, if you were to look at the SPIVA reports, that is a report put by S&P Index. Okay, so they have been studying the phenomenon of active funds, whether they're able to outperform the passive funds or not, and they have been putting out these reports for several years now in India also. So what has come out fairly clearly is that over a 10-year period, large cap index funds, large cap indices like BSE 100 have been able to outperform something like 68% of the actively managed large cap funds. So as far as the large cap fund space is concerned, it looks reasonably clear that index funds may be a better choice. Now, when you go to the passive fund, when you go to the mid and small cap space, the view becomes somewhat different, because less than 50%, something like 43% of the funds only, 43% of the times only, indexes outperform the mid and small cap index, which means the active fund manager is still doing a lot of things in the mid and small cap space, and probably there is a reason for somebody to put money in the active funds. So that is the thing. So we will have to take a nuanced call when we build a portfolio. Broadly speaking, large cap funds probably are better served with an index fund, and probably a mid and small cap fund, probably the active stock picking is going to be helpful in that sense. So that is what the SPIVA report is saying. So I think that is going to play out over a period of time. Over a period of time, even as mid and small cap stocks are covered by more and more research analysts, this thing can change. But as of now, this is the situation.
All right. So largely the trend that's been observed is that in the large cap category, the index has managed to do a bit better than active funds. But when it comes to mid and the small cap category, it's the funds, the mutual funds in the category that have managed to beat the index by a certain alpha. So then in that case, Suresh, largely then if I have to pick an ETF or pick an index fund, should I do it for the large cap space and completely avoid it for the mid and the small cap space?
Yeah, so definitely there is a very compelling story for picking up an index fund in the large cap space, because the figures seem to point out that even if you look at the 5-year return or a 10-year return, it looks like choosing an index fund over an actively managed fund is the right thing to do. But as far as the mid and small cap space is concerned, as of now, it looks like probably one is better off by choosing an actively managed fund over a mid and small cap fund. So this is something that it's an evolving situation. We will have to keep our eyes peeled open on this. And as of now, what I will say is, yes, large cap oriented funds from the index, small and mid cap fund from the actively managed portfolios is what I would suggest as of now.
Suresh, I wanted to know the cost benefit analysis of sorts for active funds, because obviously active funds are a bit more expensive for one to keep in their portfolio, thanks to all the the fees, etc., that come along with it, versus a passive fund or an index fund. If you're saying that in a large cap fund we are not seeing performance really, or rather there's a bit of an underperformance compared to the index fund, and I'm also having to pay higher costs. So if you could just walk us through the entire cost benefit analysis then of these active funds.
So there are two things. One is the regular and direct. So I'm not really going to go to regular and direct at this point in time, because regular and direct funds are available in both categories. So let us take the case of direct products. So let us look at index or ETFs in the direct space. So typically the index or ETFs in the direct space, direct plans, will be something like 0.4% or less. So there are index funds which are offered at just 0.05% also, 0.1% also. So I'm saying that the typical index or ETF will be less than 0.4%, and the typical actively managed fund will be typically 1% or more. There are going to be variations from, in specific cases, but this is largely how it is going to be, arrayed. So something like a 0.6% difference is expected, or probably it can be more than that also in some cases. But Mubina, what we have to keep in mind is that the return that the investor is going to get is what we have to look at. Not just the cost alone, because if the return from an actively managed fund is, let us say, 2.5% higher as compared to the index, then the cost should not really be a concern, right? I mean, even if there is a 1 or 1.25% extra cost in an active fund, if the outperformance is significant, then the cost should not be a consideration. So we will have to look at the return post the cost, post the expenses.
So basically, cost should not at this point of time be too much of, or rather it should not be the first point that someone should see when they're compiling a portfolio, in a mix of passive and active funds. You rather look at the return potential, etc. So keep cost as a more of a secondary thought, and put returns obviously first. Okay, Suresh, what about riskiness? Or do you think that both these categories, riskiness is not a point really of comparison for both these categories?
See, the market risk is there in when you invest in equity. Market risk is always there, but in the case of an actively managed fund, there is also a fund manager risk. The fund manager can do a wonderful job, or because of the selection, it is possible that some of the choices may underperform. So there is a fund manager risk in an actively managed fund. In the case of passively managed index or index funds or ETFs, so they are going to track the underlying index. So in that particular case, that particular risk is not there. It is going to be basically the wisdom of the crowd. So basically, whatever is the return that the index is going to give, this is more or less going to mirror. So to that extent, that risk is taken out. And in the long term, if a person is not really going to do the portfolio reviews and things like that very actively, at least once in 6 months, probably they are better served by an index fund, where automatically the constituents which should come in and which should go out are taken care of by the index construction team itself from time to time. So that is what I would say.
All right. Okay, understood. So that's largely summarizing everything you need to know about active funds, passive/index/ETFs. You know what, ladies and gentlemen, we'll also give you the opportunity to ask your questions to Suresh. If you do have any, you can shoot them to us. Our email address is themoneyshow@etnow.tv. But before we do that, I just want to address an important news piece, and that is the world's most popular cryptocurrency, the Bitcoin, has surpassed $50,000 for the first time in history as it continues its blistering rally. Major companies, remember, are warming up to the idea of investing in cryptocurrencies, and not just investing, but also using it as a mode of payment for their products. In fact, it also managed to hit a record high of $50,487. But remember, folks, back home, and I want to caution this for all of our viewers, we do have a cryptocurrency bill that will be facing the parliament very soon. We don't know what shape or form that may take, so I would advise wait for that before making any investment decisions in the crypto. And let's not forget, the Bitcoin is extremely volatile, so it does bring along with it a fair share of risk too. But you know what, we'll do one thing. We'll take a very short break. Suresh, stay on with us while we wait for our queries to accumulate. We'll be back with our Ask the Money Show segment. Welcome back. You're watching The Money Show on ET Now. We have with us Sudesh Sadagopan of Ladder 7 Financial Advisories. We were talking all about, passive versus active funds. And now it's time to take on board the questions and queries that you have sent us. So let's get straight to that. Our first question is from SB Sivakumar. He asks you, Suresh, what's your opinion on the Tata Digital India Long-Term Fund and the SBI Dynamic Asset Allocation Fund for an SIP? So it's a thematic fund actually that he is asking your view on, Suresh, and then there's a dynamic asset allocation fund as well. Unfortunately, he's not exactly mentioned what his goal is or time horizon is, but if we have to maybe just give a very objective view on it, what's your view overall, Suresh, on having a thematic fund in one's portfolio? And of course, if you could talk to our viewers specifically on these two funds that he's spoken about.
As far as thematic funds are concerned, this is not something that we recommend a lot. We feel that if there is a theme or if there is a sector which does well, the fund manager also does know about it, and the fund manager will definitely include that in the overall portfolio. So in the case of the IT theme, that particular fund which he has in the portfolio, Shivakumar has in the portfolio, see, I mean, it's a good fund if you want to have exposure in the IT theme. So there is no problem on that front. But the only thing is, I would recommend an exposure in an overall diversified equity fund and allow the fund manager to bring in IT to the extent required in that fund, rather than actually taking a bet on a particular theme or a particular category. So that is my view. There are obviously certain other people who want to take a deep exposure into that category. And Shivakumar, if you are one of those people, it's absolutely fine. But look at the overall exposure in your overall equity portfolio. I would say that thematic and sectoral exposure should be less than 20%. So that is my view again. And as far as the dynamic asset allocation fund is concerned, I think considering the current situation, especially, I think dynamic asset allocation fund has a place in the portfolio, especially considering the kind of volatility that we are currently seeing at this point in time. And considering the point at which the index seems to be poised at this point in time. So dynamic asset allocation fund seems to be a good bet, and SBI Dynamic Asset Allocation Fund is one of the better performing funds in that space. So you could retain that for the SIP.
All right, got it. Okay, so that's the view on the two funds that our viewer has asked us on. Let's take on board our next question. Anil Kumar writes in saying, I'm a senior citizen and seek your advice on my mutual fund portfolio. He wants to know what you think of the funds that he has, and should he, retain all of them or redeem some of them. All right, quite a few funds: Kotak Standard, Multi-Cap, Tata Balanced Advantage, SBI Magnum, Low Duration, there's a debt fund inserted there, SBI Banking and Financial, again another thematic one, SBI Equity, Nippon India Pharma, DSP Dynamic, ICICI Pru Balanced Advantage, Kotak Small Cap, Kotak Emerging Equity, HDFC Hybrid, ICICI Pru, Axis Long Term, Axis Mid Cap. Okay, quite a few names really. Okay, that constitutes the rest of the portfolio. So his total portfolio is 1.05 crore rupees. He's saying he's looking for a monthly tax efficient return of 1 lakh rupees per month for his running expenses from Jan 2022 onwards. So I presume that's when he will perhaps be retiring, or his regular income will either reduce or pause, and then he's hoping that he will be able to earn a return from these funds. So many funds really, Suresh, what do you think of it? Do you think this is a good portfolio? Do you think it needs to be a bit more crisp?
So as far as Mr. Anil Kumar's portfolio is concerned, what I would say is probably this is the equity portfolio, or predominantly equity portfolio, that he is telling us about. So if this is the main portfolio that he has, obviously it cannot be in equity, and especially considering the fact that he wants a 1 lakh rupee return from this, I mean, any investment return on a consistent basis, if somebody wants, we normally set it up only for the debt funds or fixed income instruments. So anyway, this portion of the portfolio, number one, it is there are too many funds in too many categories, and some of the funds in some of the categories like small caps and all that are not even appropriate for a person who is on the verge of retirement. So so I don't know the specifics of the portfolio. So if this is the main portfolio, you will have to number one, move this into debt if this is the main portfolio, and you will have to set a far more realistic expectation of what you can actually get from this portfolio. I mean, 1 lakh per month will translate to something like 12 lakhs per annum. So that is unrealistic at this point in time from a debt-oriented portfolio. So it's not really feasible at this point in time. 6% return or 5.5% return is what one can expect through the systematic withdrawal route if one is investing in the I mean, debt-oriented products. There could be other bonds and NCDs which are available in the secondary market that one could look at to get a slightly higher return. They may not be available on a monthly basis, so that is there. So you have to look at pruning down the portfolio, number one. If this is the main portfolio, you have to move it to debt before your retirement date, and then set a realistic expectation of what you can actually take out from eat into the capital. So those are the 2-3 things that I would want to see.
Understood. All right. So too many debt funds, and it may be a little unrealistic to expect what a 12 lakh rupee per annum income from this. So some tweaks and chops and changes recommended. All right. Well, Suresh, thank you so much then for joining us today on the show and helping our viewers out with their questions and queries, giving them something to think about as well in our previous session when we spoke about active and passive funds. Thank you so much for joining in.
Thank you.
Okay, well, on that note, we'll take a very short break on the show. Don't go anywhere. We'll be back with lots more.